From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro. A lift to the markets. Maybe we're going to get an 8th straight week of gains, the longest streak going back years. The countdown to the Open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, investors pile into rate cut bets. U.S.-China trade tensions reignite. And Warner Brothers and Paramount discuss a possible merger. We begin with the big issue. The buying frenzy runs out of gas, maybe.
In terms of the sell-off yesterday,
there was sort of some money saying, maybe we want to book some profits here.
Markets taking a breather.
Having a little bit of consolidation.
Some consolidation, some, profit taking. I think makes sense.
People, just locking in profits before the markets go completely dead.
Many people are just off the desk, going on holidays.
You've seen such an extraordinary rally.
This 7-week kind of rip-your-face-off rally.
The market got into a bit of a frenzy.
I would not read too much into the kind of short-term market volatility.
I don't think we should be reading very much into what's been happening.
I think the market is going to return into the rest of the year and finish on a strong note.
There's quite a lot of big questions as we move into next year about can we continue as we move into January in this optimistic frame.
I do think you have to be careful here.
Let's just enjoy this calm right now, because I think it's going to get a lot rockier and a lot more uncertain into the future.
Joining us now to discuss Mundi's Monica Defend and Eric Knudsen of Neuberger Berman. Let's start there. This idea that there has been so much enthusiasm. Some people are trying to push back. They did push back yesterday for a hot second, and now today they're back in the buying mode. Monica, are you more in the buying mode or more in the selling mode?
Actually, we were already cautious, and we are going to hold the position we have. We have kind of a cautious outlook, and we are already positioned for it.
Eric, what about for you?
We're looking to use volatility to move from cash into assets where we think we're going to get a higher return over the next 12 months. So I don't know about buying at these levels, but there are certainly areas within the equity market that are appearing increasingly attractive when you consider that the Fed, to a certain extent, is taking out some of the risks of higher for longer.
So, Eric, were you buying yesterday? Is that sort of the dip that's buyable, or is it something that is more significant or prolonged?
Yeah, where we see opportunity, and I because I'm multi-asset, I get to look across kind of a spectrum of opportunities. We see opportunities in the short, intermediate end of fixed income, where, for example, the 2-year Treasury at 4.32, we're pretty confident that yield's coming down, and we think cash yields are definitely coming down. So we're looking for where we can redeploy cash into, attractive areas across fixed income. In equities, we're looking down the capitalization spectrum away from the mega cap 7 and trying to build exposures in some of the areas that have been kind of, left alone or left for dead for a while, and that are better value. So that's where we're looking to buy on the margin.
Monica, what does it mean when you're cautious, when you say you're not necessarily playing as much and you don't necessarily buy into the same kind of optimism that we're hearing from Eric?
Well, having in mind that we believe the United States will enter a mild recession in the first half of next year, rather than having, strong top-down directional calls, we do prefer to stay in the relative space, having preference for regions such as, or countries such as the UK, Japan, because of their sectoral old valuation appeal. Definitely bond is back, so this is where we like to be positioned amid some more structural thematics related to the net zero transition, artificial intelligence, CapEx, if not obesity medicine. So we're kind of blending some more long-term thematics, nesting with the more tactical opportunities that might come up on the fixed income and on the FX space.
Eric, when you talk about the optimism for next year, there is this concern right now that the financial easing that we have seen will reignite some of the strength that could cause inflation to either stay pretty sticky or even reaccelerate. Are you concerned about that at all?
Absolutely.
Well, we think that
when you think about the Fed's pivot or change in language and direction, it really does take out one risk that they stay too high for too long. But and that is perhaps reason to justify some of the market movements we've seen. But it amplifies the potential for having to, be a little bit more concerned about inflation. So while we don't think that inflation reinvigorating is our base case, we see kind of a continued move down in inflation, probably not to 2, but maybe the high twos. We do want to ensure that our portfolios have some hedging, have some exposure that will do well if we do get surprise inflation. And I think that's also very important when you consider, some of the geopolitical risks that are out there, and being positioned, and that could be commodities and some real assets.
And we'll pick back up on that in a minute. Monica, do you want to weigh in there?
Well, on inflation, we think we are on track, but the journey won't be linear. And again, we don't expect to land to 2%, so to the central bank's targets by the end of 2024. We will need to wait more. And probably over the next 2 months, in particular in the euro area, we're going to see some uptick. And there is a substantial difference between the US and the euro area when it goes to wages dynamics, where probably something more might be piling up in the euro area.
All right. Meanwhile, U.S. futures are pointing to a rebound following a bout of selling yesterday that saw the S&P notch its worst decline in nearly 3 months. Bloomberg's Katie Greifeld joins us for more. It's been a long time, Katie. What's going on?
Well, I'll take you back to about 2:30 p.m. yesterday. Of course, we've been discussing this over the last 3 hours, though. But you think about what happened then. Stocks quickly and suddenly taking a leg lower, finishing the day around 1.5% lower. Like you mentioned, the worst one-day performance since September. And there was no real catalyst other than it's very late in the year. And we've come very, very far when it comes to this equity rally. But regardless of the reason, you take a look at whatever fears were percolating yesterday afternoon, they appear to be an afterthought this morning. The S&P currently up about 0.7% pre-market, those futures. And that's taking back about half of yesterday's loss and inching the benchmark ever closer to that record close of just over 4,800. And this could be really a preview of the type of market that we should expect in 2024, that buy the dip mentality really working its way back into the market psyche. I'll take you back to a Citigroup strategist note out this morning, certainly saying that that's the winning strategy. They wrote in a note that 19 of 24 industry groups right now are either at or near overbought readings. And as such, they write that the message is to expect pullbacks and to buy into them. And Lisa, you raised the great point of if everyone's buying the dip, are there going to be any dips left to buy? But that's a conversation for a different time.
Katie, I'm sure we'll be having it pretty soon. Thank you so much. So with us, Monica Defend and Eric Knudsen. Eric, I do want to pick up on your point about commodities, that you're leaning into them as a possible hedge for inflation. We are seeing oil prices not participating in the rally today. Lower on the news that Angola is going to exit OPEC over disputes about some of the production targets. How do you see this evolving, given that that's been a huge tailwind in the disinflation story this year?
Yeah, so we think on the margin, commodity prices are likely to be rising from here, and there are a number of indicators to lead us to that conclusion. Pricing in the forward markets gives you a positive roll yield for owning commodities forward, which is generally an indicator of supply-demand imbalances and higher prices going forward. And that includes in the energy space, where we've seen so much volatility and downward pressure this year. We also think that commodities will benefit from a lower interest rate environment and from the reduction of recession risk. We do think recession is still a risk. It's not our base case, a little different than Monica, but some of that risk is being taken out. And then finally, there are going to be a lot of geopolitical headlines in the coming year, whether it's elections or further issues or challenges around hotspots in the world, and commodities can help hedge against that. And lastly, one of the potential surprises, which could be positive in some ways, but inflationary in others, would be if China does stimulate significantly, and commodities can help hedge against that unexpected outcome as well. So they really are going to be, robust against a number of different environments and help portfolios from a diversification standpoint.
Monica, given your recession outlook, do you lean against that? Do you talk about the potential for increased weakness in the commodity sector that's already been under a lot of pressure?
Well, I think that because of our recessionary scenario, we do need commodities as an hedge. Think about gold, for example, also against all the geopolitical headwinds we might see. But more in general, on commodities, as Eric was saying, the demand and supply dynamics are going to come into play when it goes to the net zero transition. This will create demand and support for certain commodities. So really, we think that the trend should be on an upward side.
At this point, when we take a look at the potential for increase in prices, I'm just wondering, Eric, do you think that that's going to be on strength, or do you think that that's going to be on supply chain disruptions? I mean, how do you sort of game out what's even going on, given the fact that demand is still at all-time highs for oil, and yet we're seeing prices go down as a result of U.S. production that's risen to record highs?
I mean, again, we have to look at what we can observe in markets, and forward spreads on in futures contracts would indicate that prices are going to be rising and that there are supply-demand imbalances, and those will be reflected in future prices. So that would give you one indication. And then we have to think about what other risks we can manage, and we don't have an edge in calling elections and calling geopolitical risks, or even how to position in front of geopolitical risks. And we also acknowledge that probably surprise inflation as a risk has increased, with the shift in Fed posture. And so we think that all of those make us want to own elements of the energy complex, industrial metals, and also precious metals.
Monica Defend, Eric Knudsen, both of you are sticking with us right now. Let's take a look at what's moving ahead of the opening bell as everyone buys every dip out there. Here's Abigail Doolittle. Abby.
And Lisa, we do have a number of stocks on our board that are helping give the market this lift this morning, starting off with the shares of Micron, heading to the best day right now, at least since April of this year. They put up a strong quarter. Importantly, they also boosted the forecast, strong forecast buoyed by data center demand. They're now looking at revenue for $5.1 billion to $5.5 billion for the fiscal second quarter. Investors really liking that. Boeing up 1.7%. China is said to have approved its first Boeing 787 delivery since 2021, suggesting an indication perhaps that the strained U.S.-China trade relations may be easing to some degree. And then Tesla up 1.9% after falling 4% yesterday. We do have a bit of a bounce back, as we can see by those futures for the big tech names in particular. Tesla was down more yesterday, up more today.
Abigail, thank you so much. Coming up, U.S.-China trade tensions heating up.
The Chinese have already announced in a couple of other occasions some selected restrictions on exports of rare earths, trying to show that they have cards that they can play too in this tit-for-tat trade war.
That conversation still ahead as we bounce back from yesterday's one-day dip that everyone is buying. This is Bloomberg.
The Chinese have already announced in a couple of other occasions some selected restrictions on exports of rare earths, trying to show that they have cards that they can play too in this tit-for-tat trade war. I think what we're seeing from the Biden administration is a desire to kind of adjust some of the tariffs that the Trump administration had imposed on China, and which the Biden administration left on.
Meanwhile, U.S.-China trade tensions are sparking once again. The U.S. considering raising tariffs on Chinese electric vehicles. This, according to the Wall Street Journal, trying to limit reliance on China's EV industry and shield domestic production. Meanwhile, China moving ahead with banning exports of certain rare earth metals, potentially making it harder for the U.S. and other Western nations to boost their supplies of tech and industry-critical metals and minerals. Joining us now is Bloomberg's Brendan Murray. And I'd love your take, Brendan, on how much of an escalation some of what we're hearing is. The latest headlines coming out fast and furiously, one now saying that the U.S. is planning to gather intelligence on Chinese chip makers.
Yeah, exactly. I think today's news is a good reminder that the U.S.-China trade war has kind of fallen off the front pages, but it never really has gone away. China came out today with what seems like an incremental step to protect exports of rare earth technologies, not the rare earths themselves. The U.S., it's reported, as you mentioned, is considering raising tariffs on Chinese electric vehicles. There already are tariffs on Chinese EVs in the U.S. That's why the market isn't flooded with those products like they are in Europe. But it's just a good reminder that these trade war sort of skirmishes can flare up at any time, and particularly the Biden administration is under a lot of pressure from Congress right now to get tough on China. So they're playing to that constituency as well, heading into election year next year.
There's a real divide there right now between businesses and the administration, and frankly the population when it comes to China. Businesses looking to see if they can have some stability in the world's second biggest economy to continue their businesses there, and the sort of broad-based feeling among the population as well as Washington is sort of against expanding that trade. What do you make in light of that division? Treasury Secretary Janet Yellen heading back to Beijing yet another time in the next couple of months.
Yeah, exactly. The administration is trying to walk the balance between being tough on China and understanding the reality that American companies cannot decouple completely from the Chinese economy itself. So they're trying to reduce the dependency of American industries on China, but they understand that they can't do it completely, and that many companies still depend on China for their sourcing, even if they shift some production to places like Vietnam or Mexico. So there's a bit of jockeying going on right now to find that balance. How much de-risking can be done from China without it going too far, so as to put American companies at a disadvantage, because the fact is China is still a very capable, productive economy that many economies can't really compete with yet. So it's that balance they're trying to strike, I think.
Brendan, thank you so much. Still with us, I'm so pleased to say, Monica Defend and Eric Knudsen. Monica, how much does some of this geopolitical trade tension type of backdrop really play into how you plan on adjusting your portfolio next year?
Well, definitely. There are a structural component on the way we look at market and fine-tune the active allocation or hedges in place. When it goes to the U.S.-China, our base case is for the relationship to remain calm on the surface. Let's see on the outcome of the the election in Taiwan to see if any further evolution might be seen there, and then there will be as a big and potential risk the outcome of the U.S. election. So definitely the geopolitical risk is in a radar. But it is not only a risk, but might turn into investment opportunities. If you think about this onshoring, friendshoring, new global disorder that is taking place, actually there are winners and losers. Regions such as India, Vietnam, Indonesia, Brazil, that are going to benefit from this rebalancing of global powers.
Which is the reason why you have seen a bit of a push into investing in some of those regions. Eric, you mentioned something just a minute ago about how one of the potential surprises could be a stimulus package from the Chinese government to try to ignite growth there and to actually see some sort of resurgence of the economy. Are you factoring in any of the trade tensions, or are you thinking that, frankly, people have written off that country to such a degree that it's actually an opportunity at this point?
No, we're still neutral on Chinese equities. That there are a lot of negatives, and we've highlighted a number of those. There are the positives associated with potential to, implement considerable stimulus there, and growth drivers that they have that are quite powerful. We're neutral on the stock market. We do think it's a great security selection opportunity set. What we're watching very closely is the currency as a bellwether of that stimulus, and we've been underweight the currency. We're not at the moment, but that could be an opportunity again. I think what we're looking at, though, is, to echo Monica's comments, is a restructuring of the global trade order that on the margin is going to raise frictional costs and be a part of kind of higher inflation from a base case standpoint, but also opportunities. We also, like India, see interesting opportunities there. And to echo another one of Monica's comments from earlier, we see great opportunities in Japan, where we're seeing real restructuring in that economy and continued stimulus that we think is creating very interesting opportunities. So kind of playing the non-US opportunity set in a very selective way, and then watching the dollar very, very closely. One of the potential paths for 2024 is a weakening dollar. We're not ready to make the call yet, but it could change the story from kind of US and quality-oriented opportunities to a more non-US and primarily emerging market opportunities.
And that's actually something we were just hearing from a number of investors. Monica, do you agree that the weak dollar kind of trend could gain steam into 2024?
Yeah, definitely. We have these in mind targets around the 119.40 US dollars versus the euro. But in general, with the Fed pivoting and having some asynchrony, in particular between the emerging market central banks that are somehow in an advanced stage of their policy cycle when compared to the US. Definitely, this is going to favor the emerging markets on the full spectrum, from bonds down to equities.
Monica Defend, Eric Knudsen, both of you, thank you so much. Coming up, the morning calls, and later, UK Chancellor of the Exchequer, Jeremy Hunt, joining us to discuss a groundbreaking financial services pact with Switzerland, plus Emily Rolland of Jan Hancock joining us with her 2024 market outlook. Right now, what you are seeing is a lift. We're possibly going to get an 8th straight week of gains. S&P futures up 0.7%, just minutes away, about 7 minutes away from the opening bell. This is Bloomberg. Less than 5 minutes until the opening bell. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Wedbush raising its Amazon price target to $210 from $180, viewing the company as well positioned to continue taking share of global digital advertising. Next up, Morgan Stanley upgrading extra space storage to equal weight from underweight, saying falling rates may be a tailwind for housing sales and storage demand. And finally, Pivotal Research upgrading Spotify to buy from hold with a price target of $265, seeing continued strong results and an ability to take price without significant churn. Coming up, I am so excited for this conversation. Chancellor of the Exchequer, Jeremy Hunt, on the UK's groundbreaking financial pact with Switzerland to create a closer connection between Swiss and UK banks. From New York, this is Bloomberg. 25 seconds till the opening bell, and you can see that lift continue to persist into the open. We can see a lift across the board, 0.7% for the S&P, up 0.9% for the Nasdaq. The Russell 2000 really leading the charge once again, up 1%. If you take a look outside of stocks, you can see yields lower actually after earlier being higher, 3.83%. The euro getting a lift versus the dollar. Dollar weakness very much across the board, almost to 110. Just a hair away from that, 109.93. And crude prices lower, down 1.5% on the NYMEX, $73.09, after Angola said that it was going to exit OPEC after there was a dispute over some of the production limits they were discussing. One stock to watch at the open is Apple, the tech giant ramping up production of its Vision Pro as it prepares for a February launch. Abigail Doolittle has more. Abby.
This is an interesting one, Lisa, because this would be Apple's first big product launch since 2015 when they launched the Apple smartwatch. And according to sources familiar with this matter, they are ramping up production on the Vision Pro mixed reality headset. I saw a picture of it. To my mind, it looks a little bit like a laboratory pair of glasses, but much cooler with a white frame and then a headset or a band that goes to the back. Now, it sets the stage for a launch in February. Production apparently is and has been for weeks at full speed in facilities in China. And the goal is for customer-bound products to be available by the end of January. January. Now, another reason to think that those close to the matter are correct in terms of potential February launch, they just on yesterday, sent out an email to software developers encouraging them to get ready for the Vision Pro by testing their apps. Now, it will be one of the most, or if possibly even the most complex rollout, given the fact that it requires an entirely new sales strategy. There are a lot of different equipment pieces needed, such as those head straps. It's delicate, too, because it has to be fit to your head to work correctly. It costs $3,500. Meta is out there in full force. There hasn't been so much appetite, so it's going to be interesting to see whether or not this one is as successful as they're hoping. They're going to be revamping stores. They need more space to draw people in for that potential February launch of the Apple Vision Pro mixed reality headset, Lisa.
Abby, thank you so much. Turning to earnings now, Micron delivering a strong forecast on the back of robust data center demand. Ed Ludlow joining us from San Francisco. Ed.
Yeah, good morning, Lisa. The stock up now more than 9%. If it closes up more than 9%, that would be the biggest jump since December of 2021. It's all about the outlook for the fiscal second quarter, the current period, $5.1 to $5.5 billion, above street estimates, beating on that forecast. On the bottom line as well, expecting a loss of 21 to 35 cents per share. The street was seeing a loss in the fiscal second of 62 cents per share. The story is pretty straightforward. There's still weakness in end markets like PC and smartphone, but as you said, data center is what's the driver here. There is a recovery in data center overall, but also clear demand on the AI side. Then you look to the bigger picture guidance for 2024. Micron is the biggest US maker of memory chips, and in the AI domain, what is relevant here is what we call high bandwidth memory, or HBM. They are sold out of that for 2024, which is a good indicator that their talk about the demand for AI is real and that it will start to show up in the financials going forward. Then you look at the other end markets. PC, they expect a recovery into 24, low single to mid single digits growth and a modest growth in the smartphone market. But in the PC market in particular, if Micron's right in its assumptions, that would signal 2 straight years of declines ending. They're holding out on production right now while prices stabilize.
Ed, thank you so much. Turning now to China, authorities signing off on the first delivery of a Boeing 787 jet since 2021. Katie Greifeld back for more. Katie.
Hey, Lisa. Yeah, Boeing getting a lift on the heels of that report, according to a person familiar with the matter. The jet expected to fly from Boeing's factory in Seattle to Shanghai as soon as Thursday. And this is an encouraging sign on at least 2 fronts. The first being that it could be taken as a positive signal that U.S.-China trade tensions are maybe easing just a little bit here. And 2, Boeing and Chinese airlines, they've been waiting for Beijing to allow 737 MAX deliveries after 5 years. Remember, that model was grounded globally back in 2019 following 2 fatal crashes. Now we're talking about the 787 jet here, not the 737s. But Jefferies, for example, has said it expects 737 deliveries to happen after the 787 deliveries. So a step in the process here, Boeing up about 2%.
Katie, thank you so much. Right now in markets, we do see a lift across the board as people parse through data that was better than expected, though still hopes for this disinflationary feel. You could see the NASDAQ up about 1.1%, the S&P up 0.8%, Russell up 1.31%. And really, we're looking at yields just marginally lower as everyone parses just how far this disinflation trend really can go. Right now, on Bloomberg TV and radio, I'm Lisa Abramowicz. I'm so pleased to say joining us right now is Jeremy Hunt, UK Chancellor of the Exchequer. Thank you so much for being with us. I am curious, there is this agreement that you just came to. Can you explain why it was so important to come to this financial agreement between Switzerland and the United Kingdom?
Hi, Lisa. Thank you for inviting me onto the show. This is a very groundbreaking agreement. It's never happened anywhere in the world before, and it links 2 of Europe's largest financial centres, the City of London and Zurich. And instead of doing what previous trade deals and mutual recognition deals do, which is try to align legal frameworks, what we're doing here is we're saying that in the UK, we will allow Swiss companies to operate following Swiss regulatory structures and rules. And in Switzerland, they will allow British-based companies to operate following UK rules and regulations without the need for both countries to align their legal frameworks. And so in terms of the wholesale insurance market, asset management, banking, this is a really significant deal, but also could be a template for the kind of deals that the UK does with other countries going forward.
That's exactly where I was going to go. Chancellor, who's next? What other country?
Well, we're open to discussions with anyone. What I would say is it was much easier to do this deal with Switzerland because there's a lot of trust between Switzerland and the UK. We've been friends for a very long time, and there's a lot of confidence in each other's legal systems and regulatory structures. But we're open to this kind of discussion with any countries all over the world. Anything that boosts choice and competition whilst respecting our sovereignty and our ability to make our own rules and regulations is something we're happy to talk.
Chancellor, how important is this, given the fact that there have been discussions about financial hubs moving to Paris or moving to Frankfurt or Berlin? How much is it important to get some of these connections in order to boost tax revenue and keep the banking sector in the United Kingdom?
Well, we've had a lot of discussion post-Brexit of people, banks, operations potentially moving out of London. But it hasn't materialized on anything like the scale that people predicted. London has shown itself to be very resilient. And if you look at what's happened in the last year, what we've done in the UK is we've shown we're going to be hungry to keep all that business that's come to London. We are very committed to financial services in the UK. We passed the Financial Services and Markets Act. We are changing the rules for prospectuses and for all sorts of the rules around IPOs to make the London Stock Exchange more competitive. We've got the Mansion House reforms, which is going to unlock a lot of capital into growth businesses from pension funds. So we are really motoring in the UK. We're hungry to attract business all around the world. And this deal with Switzerland is just another step in that direction.
How much are you looking to some of these revenues, though, to be able to enact tax cuts? You were talking about additional tax cuts coming down the pike. Are you still planning that? And specifically, where are you planning to have those tax cuts? Is it going to be with the savings or property, other areas?
Well, Rishi Sunak and I have said that we would like to cut the tax burden more if we're able to do so. But we won't be in a position to do that until much closer to the spring budget. We haven't announced a date for that yet. But, you know, we won't find out what the latest forecasts are from the Office of Budget Responsibility to know whether we're in a position to do that for some time. But we would like to bring down the tax burden in a way that is responsible if we're able to do so. But right now, our priority is to bring down inflation. We had really good news yesterday, 3.9% inflation, beating market expectations by some way. That is because we have shown discipline in government. We've taken decisions that have supported the Bank of England in what they're trying to do with interest rates to bring down inflation. And it's still above target. We've still got more work to do. So that will remain our primary focus.
There is a concern around strikes. There was another strike shutting down some of the train systems recently. That was some of the reports this morning. Doctors are striking again. Are you prepared to start to materially increase salaries at a time when you're still concerned also about inflation?
Well, that's a very important question to ask. And what I would say is, I put it the other way around, actually. I would say the reason why we're having these strikes is because when I became Chancellor, after what Putin did in Ukraine, we had inflation of 11.1%. And people can see their living standards eroding because the price of the weekly shop, the price of filling up the car is going up. So the way that you bring back industrial harmony is to bring down inflation. And that is why it is the primary focus for myself and Rishi Sunak. And when it comes to talking to junior doctors in the NHS or train drivers, we're always prepared to be reasonable, pragmatic and sensible. We've always said we're not going to agree to pay deals that threaten our progress in bringing down inflation, because that doesn't help anyone if you agree to pay deals that mean that next year's inflation ends up being higher. But, you know, we are willing to talk to anyone at any time to try and come to a reasonable solution. And that's why more than 1 million employees in the NHS have agreed to deals. why unions in many other parts of the economy have agreed to deals, and we hope the small number of unions that are holding out will also do the same.
I do want to just finish up from a markets perspective. The markets are now pricing in almost 6 rate cuts by the Bank of England next year as they look at the pace of disinflation. Is that your base case as well?
Well, chancellors never comment on interest rate movements for reasons that you'll understand, Lisa. But what I will say is that I think people will start feeling more optimistic about their own family finances when they can see interest rates on a downward trajectory. And the best thing I can do is to support the Bank of England in their efforts to bring down inflation. And that's what I'll continue to do.
And if inflation goes down, does it give you more headroom to cut taxes?
Well, if debt interest payments go down, then potentially that gives me more headroom, and I could use that in lots of different ways, but I would never use it in a way that compromised the battle against inflation.
Jeremy Hunt, Chancellor, thank you so much for being with us today, and hopefully we'll speak with you again soon. Coming up, media giants Warner Brothers and Paramount teasing a possible merger.
We do think that reaggregation on the streaming side is inevitable. It will likely take some time to play out, but this potential consolidation or whatever permutation you want to throw out there is all one step closer to that end goal.
That coming up next, and we'll catch up with John Hancock's Emily Rolland. All of that coming up. This is Bloomberg.
All of these companies are in a challenged position right now because of the debt loads that they have. And that has limited the flexibility that these companies have as they're coming through the streaming pivot that they're looking to make and trying to get to the other side with the pressures of the linear ecosystem going against them.
MoffettNathanson's Robert Fishman weighing in on a possible merger between Hollywood giants Warner Brothers and Paramount Global, with both companies struggling to adapt to the rapidly evolving streaming landscape. A conglomerate is now reportedly on their list of, quote, strategic solutions. The resulting empire would likely face intense scrutiny from regulators. Ed Ludlow back with us from San Francisco. On one hand, regulators don't want probably tie-ups. On the other hand, how much is this just a recognition that some of these media giants cannot survive unless they connect together?
All of those logics are outlined in the sell-side reaction. On the one hand, they're saying, well, you have kind of the two most stretched assets in media right now, most under duress. There is a logic, including from Bloomberg Intelligence, adding to this voice, saying that a combination makes sense. Then you go to the valuations of both companies, the balance sheet of both, and ask how on earth would they get a deal like that done? And then I think antitrust is probably the top of most people's minds right now, Lisa, because of the environment more broadly. I think back to Sun Valley earlier this year and the idea that everyone was micro-focused on Microsoft buying Activision. Imagine if this idea had come about then. Even at that time, people would have said, no way, not in this environment.
And that's the reason why I think that people are reconsidering now. Ed, thank you so much. Right now, John Hancock's Emily Rolland looking into next year, writing this: volatility often creates opportunity. And if equity markets see downside moves in the face of a correction, the math may once again look compelling. Emily, I'm so pleased to say, joins us now. Emily, I was reading your note. I found it fascinating that you pointed to the earnings and said a lot of this year has been looking ahead to next year's hope. But this year's reality hasn't been that great. How much do you think that people really have recognized the reality of what the balance sheet shows?
Yeah, Lisa, it's really amazing. You know, if you look at the S&P 500's return so far this year, up 25+%, that's actually on 0% earnings growth. You look at the tech sector this year, up 58%. That's coming off of 5% earnings growth. So the fundamental support just hasn't really truly kind of justified the amount of multiple expansion we've seen. You know, we started the year at about 16.5 times forward earnings. On the S&P 500, we're sitting at 19.5 today. We're kind of edging up near the highs of the year there. And we're looking at an environment in which, you know, we've seen earnings estimates revised higher to the tune of 6 to 7% here. So there's a lot of optimism that's already baked into shares. We've seen the best of both worlds with multiple expansion and earnings estimates being re-rated here. So the starting point, the math on equities just isn't all that compelling to us. Meanwhile, if you look over to the fixed income side, and bond yields are basically sitting right around the same point that we started the year. So we haven't seen bonds become more expensive the same way that stocks have.
Which raises this question you said in your recent notes. We see the risk reward is less favorable for stocks going into 2024 than we did coming into 2023 when valuations were lower and earnings estimates were more reasonable. A lot of people, Emily, are saying that they're leaning into stocks over bonds because of the Fed put. Are you going in the opposite direction, into bonds and away from stocks?
Yeah, it's hard to fight the crowd right now, Lisa. It's just been unbelievable the way that this Fed pivot party has been playing out. You and I have been talking about this over the course of the last couple of months. A couple of statistics Charlie Bolello tweeted yesterday. The Russell 2000 is up 24% over the last 36 trading days. That is one of the biggest small cap rallies in history. The S&P 500 is up 16% over the last 36 trading days. One of the biggest short-term rallies we've seen in the last 30 years. It's unbelievable to see this optimism that's being priced into markets due to the fact that we saw Chair Powell come in very, very dovish relative to expectations last week, and the party continues here on disinflation. It's hard to fight the crowd right now. We've been invested. We've been overweight large cap equities, overweight U.S. versus international stocks. But when we look into next year, we want to find areas that are not trading at these elevated valuations. On the equity side, we're looking at mid caps, which we think will benefit from reshoring, onshoring, which another guest of yours talked about earlier this morning. And again, high quality bonds over credit. Think about things that have become more expensive. Credit spreads just compressed by 130 basis points over the course of this year. It's just remarkable to be at around 330 basis points over treasuries right now. Just no risk priced in to the credit markets today.
Are you concerned about the way that trading has transpired in markets, Emily? We were talking with Peter Scheer of Academy Securities earlier this morning, and he said what it showed us yesterday at 2:30 p.m. when all of a sudden S&P just went off a cliff and stock valuations tanked. It really showed you that there was a skittishness and people trying to explain just thin liquidity and some pretty violent moves. Does that bother you?
It does, and I think there can be a technical element to a lot of these moves, and there's certainly been discussion around that over the last couple of days. It's tough, you know, as we approach markets. Matt Miskin and I at John Hancock, we're fundamental investors. We look at earnings trends, and we look at the macro environment. We look at the data, and yesterday afternoon we're sort of combing through the data, trying to figure out what caused that big move in markets, and it was really tough to pinpoint. And I'd say, frankly, over the entire course of 2023, being an investor that's focused on the macro environment and the fundamentals, which we've gotten right, has not been very helpful over the course of this year, as markets have been almost entirely driven by sentiment. So, you know, as Matt and I look back on the year, we're pleased overall with how a lot of our calls played out. But I'll tell you, it's been a year of incredible frustration as across asset sort of dynamics that are playing out just really haven't matched up to what the macro backdrop is telling us.
I hear you, and your frustration is reflected by a lot of people. Into next year, from a macro perspective, putting markets aside, what do you think the biggest risk is? A reinflation of some sort, or a stickier inflation, or some sort of deeper downturn in growth?
Yeah, I mean, I think it's tough to see a significant reacceleration of inflation. I certainly think, you know, Chair Powell, you know, I think that's the biggest question that came out of the meeting is if we have this deficit approach, and we are seeing some of the economic data kind of reaccelerating a bit at the margin here, does that potentially reignite inflation? We think that would be probably unlikely, given the fact that, you know, these pandemic era distortions that we saw are unlikely to be repeated. So I wouldn't think that would be a huge risk into next year, growth being a much bigger one.
Emily Rolland, thank you so much. Happy New Year. Happy holidays.
Happy New Year.
We appreciate all your contributions. Coming up, the market moving events that you need to be watching. That's next in our Trading Diary. 26 minutes into the trading day, time now for the trading diary. What you need to be watching this week: Nike earnings coming after the closing bell. Friday, we'll get the PCE deflator and durable goods orders, followed by new home sales and UMISH sentiment, plus the U.S. bond market closing early for the holidays. And we do wish you a very happy holidays as we wind down the year of 2023. This was Countdown to the Open. This is Bloomberg.